on to more market-moving news with easy-to-follow futures and options trades from CME Group.
Welcome to Market Movers. I'm Jim Iuorio, and Friday is the always highly anticipated non-farm payroll data. Now, this one's going to be unusual, remember, because it's going to reflect those two devastating hurricanes that happened last month. Now, we're going to be looking at using E-mini S&P options as a means of exposure to this type of binary event. Joining me is Chief Investment Officer of Kingsview Asset Management, Scott Martin.
Hi, Jim.
Scott, so is there a number that we can look at and say it's disappointing after we reflect that we don't even know what the hurricanes are going to do?
Well, the exposure as far as what the hurricanes did still remains to be seen, to your point. But I'll tell you what, does it even matter? I think there definitely could be a disappointing number, say something sub 125K. But doesn't even matter to this market these days with the Fed still, I guess, kind of on the sidelines and other economic data like GDP perking up.
Okay, so economists have looked at this and predicted 80. 80 is the number. I don't know where they get that from. It seemed like every month for the last forever has been about 180 as expectations. This time it's 80. Let's say we get 150. Is there going to be an immediate belief that this economy is running too hot and the Fed needs to act?
I don't believe so, but it does fill into that line, though, that we've seen of relatively stronger than expected economic data points of recent note, which does, in my opinion, give the Fed that lead block, to give you a football term there, send the fullback through the line, to give the Fed the block to make an interest rate hike by the end of the year.
I like it. Now, before we dive into our trade discussions, I'd like to point out that as with all market movers, it's important to view these trades as examples that allow you to see different ways to use futures and options products to either manage risk or create additional trade opportunities, not as recommendations or advice. Prices and movements are going to vary on these. When we're looking at these, the DEES E-mini contract was trading, S&P E-mini contract was trading at 25.33. Scott.
25.33 on
Unbelievable.
the ES. I mean, if you look at the chart on the ES, it's up in the clouds. I mean, it's up in uncharted territory. So it's difficult as a trader looking at the ES today and figuring out, okay, what are some relative values here? Where are some levels that I'm really honing in on? So kind of what I did today, Jim, was I looked for some value and looked for maybe a shot here to kind of get some decent risk-reward exposure, and that was specifically today in the 25.50, 25.75 call spread in the ES. It's only going to cost you 2 ticks or $100. It expires on October 11th, so a couple days after the non-farm payrolls report, as we like to say, has an underlying of 25.33, as you said. It risks the 100 you outlay to make a potential 12.50. It fills out. I'm not so sure it's going to fill out completely in, like, say, a matter of days, but if it starts to go your way, and the fact that your outlay isn't very big, don't hesitate to take this one off if you get a, say, 10 handle on the S&P in your favor.
No, I like it. And not only do you not think it's going to fill out, clearly the market doesn't think so either. That's why it's priced as 12 to 1 risk reward, which makes it attractive. And I like what you're saying. So if it doubles, maybe you take that off if you think it before Wednesday it's not going to hit that level. And I think it's an interesting trade. I'm looking at a similar way too. And you're going to stick with me on this because this is a little more complicated than we sometimes do. Remember, we always talk about how volatility gets sucked out of the market right after unemployment. So a lot of times we don't like to own anything going into that number that expires that day. So I'm looking at actually selling the week one 25.25, 25.20 put spread. And I'm selling that for 0.7 ticks. I know that sounds cheap, but it's 13 ticks away from the market. It only has 2 days left in it. And then buying the week two, so a week later, 25.40, 25.45 call spread. So after your put spread expires, you still own the call spread for another week. Now for the package, you pay 1.2 ticks. The trade risks 310 to make a potential 190. Again, that doesn't sound as attractive as yours, but it's a lot more likely to happen.
You dropped enough breadcrumbs in the forest for me to follow you through there, I believe. But here's the only, I guess, contention I have is exactly what you said on the put spread cost. I'm not so sure I would, or the put spread premium receipt, I'm not so sure that I would put that on for that little of a receipt, in the sense that, to me, you could just negate that one because it's not really going to bring in much money to pay for the call spread.
Well, here's my viewpoint on it, and tell me what you think, is that if we see a 20 on the non-farm number, everyone's going to agree that it's a terrible number, but in the same breath, everyone's going to say that it's just because of the hurricanes. We're having a difficult time ascertaining what the real damage was. So if that's what is the number that's going to knock us down 20 handles? And I don't see what it is.
There may not be one, but if there is one, then you're going to be awfully unhappy on Friday morning, my friend.
So now your opinion on the underlying strength of the economy, is it running hot?
It's not running hot, but it is running hotter than it has in the last couple of years, which is something to keep an eye on, especially as we come into a typically strong quarter, Q4.
Now, thank you for joining us on Market Movers. I'm Jim Iuorio, where we're helping to make you a better trader.